This episode is brought to you by Persona. In fintech, one bad actor slipping through onboarding can cost you way more than a lost conversion. It can cost you your compliance standing. Persona gives you the identity verification infrastructure to catch fraud early, stay compliant, and still convert legitimate users without building it yourself. Fintech Takes listeners can claim a free year of access at withpersona.com/FTT. Hello, and welcome to another edition of the Fintech Takes podcast. Today's podcast is all about bank-fintech partnerships. Now, obviously, we've talked about bank-fintech partnerships a lot on the Fintech Takes podcast over the years. Banking as a service, in particular, has sort of overtaken that topic as it's been so much in the news. Jason Henrichs and I have made many a trip to BaaS Island over the years. This episode is a little bit different. We're going to talk about banking as a service, but we're going to talk about it as one of many different partnership models within the broader universe of bank-fintech partnerships. And to do that, I was delighted to be joined by a different Jason, Jason Henrichs, CEO of Alloy Labs, and also one of the hosts of the Breaking Banks podcast series. You've heard Jason on here many times. He is a friend and someone who I lean on constantly, particularly as it relates to this topic, because he sits right at the intersection of banks, particularly regional and community banks, partnering with, investing in, and collaborating with fintech companies. Jason and I talk about everything that's happening in that world, what the current state of those partnerships are, and what that state tells us about the future and where all of this is going. We also, because Jason is who he is and who I am, we talk a little bit about things that are driving us crazy in the financial services industry as well, and get a few rants off of our chest. Later in the episode, after my conversation with Jason, I also briefly chat with two members of the Fintech Takes network, which is our community here at Fintech Takes, two startup advisors, Tom Johnson and AJ Clark, who are putting on a very intriguing event that is topically relevant for this episode. So we chat a little bit about what they're seeing in the market and the event that they're planning. So hang on to the end of the episode for that. And without further ado, here we go. Jason Henrichs. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Jason Henrichs is here. He and I are in the same time zone, which, given your travel, given my travel, given the fact that I don't live in the same time zone as you, that's an accomplishment all by itself, Jason. Happy Central Time Zone Day. Happy
Central Time Zone.
How was Easter? How was all vacations and travels and things with kids?
So this is actually, I did not intend to have this as the fintech tie-in, but I still remember circa 11 years ago, David Birch and I in London talking about contactless as the future of payments.
Hey,
and I'm going to go out on a limb and say the Bahamas was amazing for contactless. In general, the US is catching up, but I will say this. I did not carry a credit card with me the entire time on spring break with the kids.
And how did that feel as like a long-time payments person?
Amazing.
Loved it.
And by the way, I need to call out, I used to, and in fact, at the second Money 2020, on stage, the main stage, I said, why would someone go for the phone? It's the same number of like hand strokes to reach in your pocket, pull out this, because you're normally on the phone. But I do think the advent of like, it's little things, right? Like combination of time, but little impediments. Bluetooth, because why? What are you doing in line when you're checking out? You're dealing with kids or you're on the phone. You're talking to someone, you're surfing for something. Now that is all seamless, right? It's expected, that norm is gone, but the ability to just tap the phone and carry one less thing is so powerful. And yes, I did spend an inordinate amount of time on spring break thinking about contactless payments, how far it's come, and thinking about pricing strategy, and thinking about, it's like, why did Apple come in as a premium cost to this. Why not go for ubiquity and do a little bit more like, if you think back to the history of Samsung Pay, like Will Graylan and his pricing strategy,
I remember.
they went for ubiquity. Why? Sorry, nerding out on Jason's spring break. I was thinking about payments.
Well, it sounds like you got away. It sounds like you unplugged, which is like very healthy. Indulging your instinct to just leap into whatever topic, I did want to offer you a chance, Jason, before we talk about the subject of today's podcast, which is not payments and is not what we're about to talk about. It is, in fact, bank-fintech partnerships we will get to. I did, because I care about you as a human and want to offer you this sort of self-care opportunity. I wanted to give you the opportunity to rant about the news from the Treasury Department that came out today, as a matter of fact, meaning that it's fresh content. I didn't write about it. You haven't podcasted about it. The news that for the forthcoming Trump accounts, which are essentially investment accounts for children that are seeded by $1,000 sort of grant or donation, whatever you want to call it, from the federal government, and that are available to any child born in the U.S., those accounts are going to be administered and sort of created by a partnership between the Treasury Department, the IRS, BNY, which is going to be managing the accounts and acting as sort of the financial agent, and Robinhood, which will serve as the brokerage and initial trustee for the accounts, as well as assisting in the product design for the white-labeled Treasury app that is also going to be built for these accounts. Jason, your quick take on this news.
There is no quick take. You have now ruined whatever zen I had. Let me wait. Hang on, getting my soapbox back on my soapbox. All right, let's talk about all things wrong with this. Let's start with the premise first. If we are actually trying to improve the financial lives of young Americans, which I do think is fundamentally good, needs to be broken, we need to unseat this idea that spend is better.
Yep.
And we put so much on spend. We put so little emphasis on save and financial management. We do not teach children the very basics of their own fiduciary responsibilities to themselves. We are a spend-based culture, a debt-based culture. We spend a lot of time about this, ranting amongst ourselves around, credit repair and credit access. Maybe you need to not learn about credit. You need to learn about spend management. Now, what are some of the fundamental problems what could we do better with this money? Let's start with that as like the fundamental thing here. What if said money went into a 529 and seeded education? So if some proponents want to solve things such as reduction in abortion, do you know what the number one reduction in abortion mandate you can do? Do you know what reduces abortion more than anything? Education. Turns out the highest correlation in reduction is not actually more restrictive covenants around healthcare and access to healthcare. It is education. You fund education, you will reduce abortion. You want to reduce gun violence? Guess what the correlation is? Education. If you educate people, you reduce gun violence. So rather than putting $1,000 into a spend account, what if we funded education?
Well, so one thing, I don't disagree with that, and I like that idea. One thing I will note on Trump accounts, which are like the modern incarnation of an idea that's been kicked around for a long time, on both sides of the aisle, actually, is, and this is something I had to clarify myself when this news came out, Trump accounts function, I guess, basically as retirement accounts, right? So not like a 529 in that it can be used for qualified educational expenses, but more something that converts into a standard sort of IRA with associated penalties for removing money earlier. So think of it more as a sort of seeding for a retirement account than it is anything else, though I don't disagree with any of the points that you're making.
Well, it is seeding for a retirement account, but it is easy opt-outs to liquidate. Sure. So if you make easy off-ramps, because an off-ramp can be used for everything.
Yeah.
As opposed to things that have fundamental social goods. I think that's one of the problems.
This is like access. People say access. And it's like access is an on-ramp
you know what?
and an off-ramp, right? I never thought about that, but like an on-ramp is an off-ramp, just you change the direction. So it's the same thing.
Change the direction.
This of course ties to the obviously involvement of Robinhood specifically.
Yeah, well, let's get to that next.
Yeah.
But this back to democratize everything, is that a good thing?
Yeah.
Right? Like as an active angel investor, I can tell you one should not actively angel invest if you think it is going to generate wealth, which let's tie that into who you go partner with here. Should we be creating access to your, whether it's for retirement, education, or something else? Should that platform be where you can also trade crypto? This is not anti-crypto, but should that actually be something that you have a fundamental exposure to, easy access to, meme trading, right? Like, is this all about GameStop trading, things with low fees that incentivize more active gamification of things? Not everything should be democratized. Not everything should be gamified. Should that also give you access to, oh, guess what? You can do sports betting. Yeah, sports betting. That should be part of someone's well-rounded portfolio is exposure to the Green Bay Packers. Well, actually, no. You should have exposure to the Green Bay Packers. But besides that, besides the Green Bay Packers.
Besides that one.
Should you also have access to, the Kalshis of the world? Right? Like, should this actually be something you can say, like, prediction markets should be part of your portfolio? To me, if you're looking to actually incentivize a better financial future for people, is giving an unlimited exposure, even if it is geared towards retirement, but it has easy off-ramps that can be used for anything, maybe that's not the best approach to fundamentally change financial futures.
I very much agree. And I will just add to your wonderful rant that Robinhood obviously has been lobbying for this position. It apparently was the subject of a great deal of lobbying by lots of different firms who wanted in on this. So clearly, like, people look at this as a commercial opportunity, which they should, right? Because even though it's operationalizing an initiative that's coming out of the Treasury Department, even though apparently Treasury is going to have its own white labeled app, which I think is really strange, by the way. Like, we didn't even talk about that, but like, that's weird. Like, I'm going to download Treasury's like reskinned Robinhood app, essentially, is kind of my understanding of how it'll look and feel. That's weird by itself. But then clearly there's going to be cross-sell opportunities, both in terms of the money that can come out of these accounts when you liquidate it, pay a quick penalty, do this, blah, blah, blah. The assets that can go into retirement accounts, which we also didn't talk about, but like, there's a big push to sort of open up the ability for retail investors in their tax advantage retirement accounts to get into private credit and private stock and crypto and all kinds of things. So we're trying to find ways to add those assets into these types of accounts. And then the third thing is just the cross-sell opportunity off of it, right? Like, Robinhood is going to have privileged access to communicate with, market to, educate, if we're going to use that word, young, vulnerable retail investors, right? And I mean, Jason, you have kids, I have kids. It's something we should keep this in mind.
Versus educate.
Yeah, I mean, I think that's like, people, it's funny. I posted about this on Twitter and I sort of was a little unhinged about it, I guess, but I was surprised by the number of people who kind of told me to calm down. And it's like, you know what? I don't want to calm down, because Robinhood, to me, gets zero benefit of the doubt. People were like, well, but like, it could be okay. And I'm like, yes, it could, if the people who were doing this became fundamentally totally different people driven by completely different incentives. Like, yes, it is possible. And again, I kind of like Trump accounts, baby bonds, whatever you want to call them, like, as a theoretical idea. Like, I like it, I mean, seeding money early and letting it grow and giving people more access. Like, I like all of that.
I mean, but Buffett was right. Compounding interest is like the secret sauce.
It's the eighth wonder of the world. Right, exactly. So like, that is true. And this will give the ability for more people to experience that, which is great. But again, like hands on the wheel, who's driving this? Who's designing this? What are their incentives? How do they behave just in terms of being responsible market actors? And Robinhood fails all those tests like 10 out of 10 times. And so, yeah, I don't think this is good. I was thinking, Jason, the only way that it could be good is if it takes so long for these kids to age up, right? So like this program just started. They're only going to get access to it when they're 18. So like, let's just maybe theoretically imagine that 18 to 20 years from now, Robinhood is an old fuddy-duddy company run by old people who sort of become boring and lame. Yeah. And as soon as they're ready to graduate into the world of investing, Robinhood is now like the comparatively safe option compared to whatever fintech crypto thing is going to be trying to grab those young customers at that time. So that's my only like glimmer of like a way to look at this positively. This episode is brought to you by Persona. Every fintech founder hits the same wall. You need to verify users, but off-the-shelf solutions aren't built for how your product works. Persona is the identity verification platform that puts you in control of your flows, with the automation and scalability to take you from your first 100 users to your first 1 million without replatforming. There's a reason that companies from YC-backed startups to publicly traded fintechs run on Persona. And right now, Fintech Takes listeners can claim a free full year through Persona's startup program at withpersona.com/FTT.
I would like to call out your glimmer means that the other options are worse, which I'm not sure the glimmer of hope is. If the thing that you think is bad, hold my beer, it's about to get a whole lot worse around that.
Jason, this is what I'm reaching for in 2026. In April of 2026, this is like all I can possibly reach for, which actually brings us to the topic I wanted to have you come on and talk about. I knew we were going to get distracted by other topics, but let me nail you down on this. April 2026, I want to talk about bank-fintech partnerships. And the reason I want to talk about it is that I've just spent the last however many years talking mostly about banking as a service. So when we say bank-fintech partnerships, what we have meant on this show, and Mikula is to blame for a lot of this, is banking as a service and all of the like intricate problems that different banking as a service providers have had. I know you've been on the other side of trying to establish like a center of excellence and like making banking as a service as a function work better. But that is one small, albeit dramatic and interesting corner of a larger universe of ways in which banks and fintech companies are working together. And I will say, it does seem to me like the long arc of history in our industry is that banks and fintech companies eventually mature to the point where they realize in some fashion they need to work together. And so I wanted to figure out what was happening in this space. You're the best person to talk to about this. So before we get into the details, Jason, just what is the state of bank fintech partnerships now in this moment, April 2026?
So it's funny. This is something you crystallized for me because you knew I was going to go here.
Yeah.
Right? Like fintech always equals BaaS or partnership banking, right? We don't talk about BaaS anymore. We now talk about partnership banking.
Right.
And I'm always like, no, like we can't do this because the amount of time I spend with regulators and they're always like, everything is like, oh, that's BaaS. It's like, well, it's not all BaaS. So I have decided I'm going to start coining a new term for this.
Okay, here we go.
We're going to talk about bank product partnership, BPP.
Ooh, you have an acronym and everything. Look at you.
We're going to talk about BPP.
Okay.
Versus CPaaS, which is charter partnership as a service. So it isn't just rent a charter. So CPaaS is all about when the partner owns the customer and the vendor of sorts, which regulators don't like to hear this and the banks don't want to say this, but they are the vendor. They are the service provider, though, of the regulatory oversight access to the payment rails. That is our CPaaS.
Okay.
When we talk about product partnership, that is the fintech in this case is actually selling a service to the bank that actually it is the bank that owns the customer. And those are two very different things that are in very different states of the world. So let's talk about CPaaS for a second, right?
Okay.
This
And I'm sorry,
partners.
charter partner as a service.
Yeah. Yes.
Got it. Okay.
Right.
All right. I'm
have a
loving this.
charter.
I'm loving this new acronyms. Okay. Fantastic.
You want access to my charter and regulatory oversight, I will give that to you as a service. We will co-own the customer. You are the primary owner of that user interface in my CPaaS world. That is getting very interesting right now because in the new world, right now, you can actually go get a charter if you want to, right? So we've had close to 25 applications right now. Let me check my notes here as prepping. Everyone from the Mercuries of the world, the PayPals, you've got the externals, the Revoluts, the new banks, right? The new entrants that are saying, hey, we're going to go direct to charter.
Yep.
In this world, you have this dual system world, and why and where do I fit in this? And I think this is going to be really interesting. And I think one of the fundamental underpinnings are the economics that rule everything. And I think fundamentally, we cannot see more businesses that are ruled by interchange. There's just not enough interchange to go around. And I think one of the things that's really interesting, and I did an interesting podcast from Utah about this, was, are a lot of the applicants really looking to become banks, or are they looking for less regulatory oversight from a partner and want to be direct, but they don't want to be lenders?
Right. So there's kind of this question of like the relationship between business model and regulated status, right?
Yes.
And so like if we could break this down into like maybe 3 topics, right? It's your regulated status. And, we should be candid about the fact that particularly post Synapse, post Evolve, post all of the stuff that happened, like it's kind of annoying to have bank partners enabling this service, right? This charter service where like they're going to, and I've heard this complaint a lot, right? Maybe Mercury is a good example of this, right? It's like, this is annoying. The bank partner is always telling us that we can't do something. We'll hear about something that they'll hear about in a supervisory exam, but we can't hear about it directly because it's confidential supervisory information and we don't know why it's being asked and we can't push back. So like there's a lot of annoyance on just the status of either being a regulated entity or having your feet held to the fire by a regulated entity, and one is like more or less pleasant than the other. So that's one. Number 2 is often related, but not necessarily business model, right? And I think a regulator like the OCC would sort of naturally assume if you want to be a bank, you want to play all the fun banking games that we offer. You want to be doing deposits, you want to do lending, you want to take advantage of net interest margin, you'll have a non-interest income business that'll supplement that, blah, 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 blah. Typical bank business model. We obviously know of a bunch of companies that are in the banking or neobanking space that don't necessarily want to play all the parts of that same model. We haven't even talked about crypto and bank trust companies yet, but we'll get back to that. And then the third category, which also ties us to bank trust companies, is access to payments infrastructure. And that feels like the third sort of category of like, we would prefer not to rent this infrastructure that's core to our business. We would prefer to have a skinny
direct
master account, let's say, at the Federal Reserve so that we can take advantage of these different capabilities. We can be principal members of Visa and MasterCard, blah, 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 blah. So back to you.
So I am very empathetic to wanting the direct relationship, right? Like it's crazy to think back at, Perk Street circa 2010, right? We're up and running. We're now having to go through our bank partners who would say, regulator was upset about this. Can't tell you why, because that is covered by supervision. But you need to go fix something. And we can't give you specifics and you cannot actually go lobby yourself, right? To your point, like that was a hard relationship. The thing that I don't think it fixes when we fast forward a decade is having a direct relationship with the regulator that is independent of your bank supervisor, your bank as your supervisor, I should say,
Yeah.
That is, if you're in this mixed version, those things, like, unless we actually say, hey, we actually need to like open up all of this and say, hey, I'm regulated, you're like regulated, we have a regulator, let's all have an open conversation. I think that's where we need to go. And just having a charter a la Mercury working with a partner bank doesn't solve that.
Yeah, that makes sense to me.
Go.
Well, so then I was going to ask you about business model as the second one. And you said that interchange only obviously has its limitations or its drawbacks. It feels like the flip side to that, which is also challenging, and you and I have talked about this before, is lending is a get your teeth kicked in for years before you figure out what you're doing kind of business. And I think a lot of the most successful fintech companies that we have that are either in the process of pursuing a charter or may pursue a charter, the problem is like the ones that really knew how to do lending and figured that out early, they already got bank charters. I think Affirm is maybe the only one of the ones I've seen that doesn't have a bank charter but clearly knows how to lend money and will thus benefit probably the most from getting an ILC in Nevada, of all places, and then being able to take in deposits and use that to fund their loans. Like, that model makes sense to me because they already know how to do the hard part. But any of the sort of payment-oriented neobanks, anyone who's dependent on interchange, even companies like Nubank that are coming into the U.S. from other markets, or Revolut, like, they don't know what they're doing here as it relates to lending money. And it has always seemed to me, and I guess Varo is sort of the like test case for this not going well and kind of the cautionary tale.
I was going to say test case.
Yeah. Maybe the cautionary tale is a better way of describing it. It was a test case a long time ago. Now it's a cautionary tale. Like, if you don't know what you're doing with lending, particularly if you're working on kind of the lower end of the market where banks have traditionally not spent as much time or sort of ignored, scaling into lending in that environment is going to be very, very, very challenging. And so I'm a little, going to your point, like, do you think we'll see fintech companies get charters, but sort of when their regulator asks them like, hey, so when are you going to get into lending? They go, oh, that's not our model. Like, is that going to happen? I mean, this is kind of giving me like Erebor vibes a little bit too, where Erebor was like, yeah, we got a charter, but we're only going to lend out like 50% or less of our deposits. And the regulators were like, well, that's not really how banking works, but sure, give it a try. Like, what's going to happen there?
I mean, you need a revenue model, right? Like, you still need a revenue model, right? Like, the Erebor part is interesting to me, right? Which is like, let us say as a source of strength is we're only going to lend 50%. It's like, okay, but then how do you make money?
And the answer, by the way, might just be Peter Thiel likes us and will just give us money so we can exist, and that's our business model. I don't know. Like, when I look at things like Erebor,
you know what I also liked, Alex? I like my subsidized burrito being Ubered to me for a long time that is no longer being subsidized. And now that my wife's salad is no longer being subsidized, being sent, I'm like, you cannot Uber a salad every day.
The VCs promised you that you'd have that forever, Jason. And then where did it go? Where did it go?
Yes. Where's my Ubered burrito? But
I miss the millennial subsidy that we used to have. I'm with you.
But so let's tie this back to the bank product partnership as a service for a second.
I would like to. Yes.
Because I think something we keep glossing over is the idea of doing the fees and services being based on value. And I think one of the fundamental issues we have in the US, more so than lots of the other parts of the world, really comes down to we expect free. We have condition free, right? And back to the quote, if you don't know who the customer is, you're the customer. Or I prefer, like, if you don't know, who the idiot is at the table, you're the idiot at the table. That's me.
Yeah, you're
right?
You're the
gambling.
fish at the table. Yeah. No, that's true. Well, and like specifically to put a fine point on it, it's that core bank account that we've sort of conditioned people, right? Like, this is free, checking is free, and this is stupid, right? Like, hey, I would like to give you all my money. I would like you to keep that money safe. I would like you to make that money accessible to me anywhere in the world at any point in time. I would like to be able to call and ask you questions. I would like to be able to come and access physical cash at the drop of a hat super conveniently. And I would like all of this to be available. And it would be ideal if you could pay me at least some interest some of the time. Like the thing I just described is very expensive to deliver. It should not be thought of as something that is free. And yet that's the market we live in.
Yeah. Because the expectation is, right, like I can get it for free elsewhere.
Right.
So why can't I get it for free from you?
And this ties us back, by the way, just briefly to business model, because the reason I, as a bank, might want to compete at the level of giving this away for free, even if I'm doing a disservice to the ecosystem overall by convincing consumers that they're getting ripped off if they're not getting it for free, is because I'm using this to fund lending and potentially very risky forms of lending that maybe aren't sustainable. But this is kind of the tragedy of the commons of the US banking market, right? Is that it drives us down to a point where I have to compete on deposits being free so that I can use the deposits to make money at a thing that consumers that I'm getting the deposits from don't necessarily see or equate to what they're trading.
Which comes back to, I'm trying to think what brilliant person, was pushing me on this before. I think it may have been Raj Data around, at the end of the day, banking is about asset transformation and liability transformation and time transformation, right? So I'm going to take this from you for free. I'm going to go do a risky thing over here. I'm going to give you services that I'm unbundling so you don't understand the actual cost and value of, right? And in that black box that is really created by regulators.
Yeah. And,
right?
and theoretically supervised closely by regulators. Yeah.
In theory, supervised, right? Like, and that's the business model. And it's funny, tying this back to spring break. So to go get coffee every morning, the daughter's not at 6 a.m. every day. We're walking to go get coffee through the casino.
Yep.
And the girls loving, at 9 and 7, like flashing lights, there are games. Can we play the games? It's like, well, and explain casinos, right? Especially slot machines, which if you think about it, at the end of the day, embedded in slot machines is a business model about who wins and loses. And the daughter's asking, it's like, well, if you play a slot machine and you're going to lose 52% of the time, why do people do it? I'm like, do you see the flashing lights? Yeah. Do you like the little cartoons playing? Yeah. Do you like the idea that you could win big? Yeah. Do you think you might go play that? Well, just a little bit, right? And therein is the tie, though. And I think part of the problem that we need to think about, and this does go back to the crypto accounts and being able to do prediction markets and others.
Yeah, gamification.
The business model of banking and the lack of transparency in the middle of a lot of this, I think is one of the dangers. And back to the idea of banking products, partnerships as a service, my BaaS.
So we're doing BaaS and we're doing CPaaS, just for the folks keeping acronyms clear. Got it. All right.
The idea that if I can create actual transparency around the value I am bringing and things you are willing to pay for, like real value, that you're like, yeah, that's worth it to me. Is it
totally
100% economically rational? No. Like I was thinking about this with a friend a couple of weeks ago. AAA is like, you still have AAA? I'm like, AAA is worth $129 a year to me.
Yeah.
Do you know why? He's like, but when's the last time you used it? I'm like, I can tell you, it was 2.5 years ago. Just had a flat tire. Did you know what was awesome to me? It was worth $129 a year to that point. She had a flat tire. Somebody else went and fixed her flat tire on the side of a road, and I did not have to worry about it. That is worth $129 a year.
And the emotion is just as much a part of it as anything else, right? So like to your point, and I think this is a really good point, this idea of, so building on it, this idea of bank product partnerships, bundles, BaaS as a service, is that banks need to get out of the business of a deposit account that doesn't do anything, that's unbundled from everything, that you get for free, but you have to keep a minimum amount of money in, which is a race that we basically, it's a race to the bottom where we hit the bottom. And now we're sort of dealing with like hitting the bottom. They always say race to the bottom, like this is the bottom right here. So the idea is to build bundles, to build value-added services around your core product that people are willing to pay for. To that point, the idea that a bundle needs to make complete and utter economic sense is stupid and contrary to our lived experience as human beings. You pay for AAA. I really enjoy Costco. Costco is, in some senses, probably not always the best deal for me. Like, it's great and I love the experience of it, but I also end up with like a jar full of like peaches that I'm probably never going to eat, and it's way too many peaches. But I like the experience of going and trying things. I enjoy getting in early by having my executive Costco membership. Like, they bundle a lot of both tangible, real things and intangible, fun, sort of brand affinity type things together into one experience that I personally enjoy. Those are all examples of a combination of real value and sort of emotional or perceived or brand value mushed together into a thing. And Jason, I guess the reason I'm clarifying that is I can't think of a lot of examples of this existing in banking. So give me an example of, if I'm a bank and I'm sort of looking around the fintech universe and thinking about this concept, what's a fintech product that's been built and that works well, but maybe the fintech company is having a tough time scaling up? Customer acquisition is the worst. Most direct-to-consumer fintech companies figure that out at some point after some level of pain, and they're looking to partner with me. What's a good example I can hang my hat on here?
Well, can I go back to one that actually works really well and is a bank?
Please do.
Until they screwed it up. USAA was phenomenal at this.
Yeah.
Till they screwed it up.
Sure.
Which was, for the longest time as a USAA member, you knew you were not getting the best deal, but you knew that you were getting at least in the top 20%, right? So I knew, like, if I was going to go shop this, could I do better? Yes. But I knew that I was not in the bottom rung. Everything was integrated. The user experience was good. The customer service was phenomenal. So do you know what I was willing to trade? If I could just know that I was in that, top 20%, right? Like, call it top quartile of products, good enough for me. Low friction. It all just works, right? They crushed it with that till they killed and they got caught going, well, you know what? Maybe we don't have to be top quartile. Could we be, top 50%? Maybe a little less, take advantage here, right? They lost their way, but they crushed it for a long time related to that. And if you look at ING was also that way, pre-Capital One acquisition.
I remember.
People loved their orange. Right? Now, of course, you have the Capital One. It's like, oh, oops, that wasn't actually your interest rate. That's just the new people's interest rate.
It's funny you're describing this, because as you're talking about it, and I'm sure I have a couple examples, I'm sure you do too, of like specific fintech things that could be added to a bundle. But I think the core of what you're saying is really important, which is just the discipline of doing simple things well. And it actually reminds me of, I'll use Costco again as an example. They've asked the Costco CEO like multiple times, like, hey, what's with this weird rule you have where you won't sell the hot dog for more than $1.50? And he's like, if you raise the price of the hot dog, I'll fucking kill you. Like, that's a real quote. They have this rule internally that they can't make more than, I think it's like a 14% margin on any item they sell. And of course, they get items that they procure that people would be willing to pay way more than a 14% margin, and they could still undercut their competitors. And the CEO is like, no, we can't. And reporters are like, why not? That would be good business. And he's like, because it's like crack cocaine. When you start taking it, you can't stop taking it. And so it's the discipline of managing those things internally. And I think to your point about ING and USAA, it's also the discipline of just like, we're always going to be the best at customer service. We're going to have a brand that promises these 3 simple things, and we're just relentlessly going to do those things and just never not be good at them. And so to me, I think you're right. Like, that's the base of it. And then I think the evolution of it, if we can kind of step into the future a little bit, is thoughtfully looking around and figuring out what are the things that would make my customers' lives better, that relate to my sort of core brand promise, and that are sort of easily or not easily, but possibly integrated into a bank account, right? And I'll start off with one example. I know this is one you're passionate about. The whole sort of bank account as a trust layer around your financial life and the financial lives of people in your life, particularly parents who are older than you and maybe the target of scams or other things. Like, to me, this is one where I'm starting to see some traction between banks and fintech companies. And it makes all the sense in the world, right? Like, really key problem, technology that exists to solve it, dovetails perfectly into our value proposition about this is a place for your money to be safe. And like, the existing status quo in the space is terrible. And so there's a huge lift on top of that. Talk a little bit about that use case, because I know that's one you spent some time on.
Oh, man. You know how passionate. So we did this deep dive for some context. Yeah. When Greenlight originally did their deal with Chase and with Arvest, a bunch of our banks within Alloy Labs were, do we need to go do a deal with Greenlight? And so as a group, we did a deep dive on, where do we think about generations? And the big aha was, our problem was not actually teenagers. Our problem was the fact that we were concentrated as community banks with old people. In fact, we found one bank's number one source of customer attrition was death. One bank found that, I love this, they had more 90-year-olds than 19-year-olds. By the way, this was a multi-billion-dollar bank. Like, I'm not talking like a $50 million bank, in Western Oklahoma. I'm talking like a real sizable bank. And they're like, yeah, we have a problem. And
it's a big one.
Part of the aha was that sandwich generation that is raising children and raising their parents, right? And dealing with it. And so we said, if we look at where the concentration of not just deposits, but also the wealth and small business, right? If you actually break down the silos in the banking, that is actually where one of the big problems are, is when you bundle those silos, we have a big problem, like a really big problem, because it is in the hands of this big, and I hate to rant about the biggest generational transition of wealth ever. It's like, okay, it's also the biggest generation, right?
Yeah.
Forget that. But it's like, when you bundle those things, that transition, which is going to take place over a very long time, but that's a really important transition. And the bank is very core to them in where their financial life lives. So how do I go get the Alexes and the Jasons of the world? And it's not just by sending us postcards, right? I have to bring value. So that led to our first was the partnership with Careful, right? And so I still remember my first conversation with Todd. He's like, why would we partner with banks? He's like, we have old people who love us and trust us. We have really bad products and experiences. You, on the other hand, have a great product that is really helpful for adult children managing their parents' finances. And by managing, what are the problems it solves? It finds missed payments, double payments. In the case of my parents, my dad falling for, like, you tell him the communists are coming to take over, he will give you his credit card number. And oh, by the way, they will make it a recurring payment, and you will actually have to go send a letter to the FTC to report them to get them to quit doing a recurring payment, right? Like canceling credit cards, right? And then he goes and gets another credit card. Finding multiple subscriptions. Why did we have 3 subscriptions to Time Magazine? You send him the postcard. He fills out the postcard. The next one shows up before it's processed, right? So it helps you find all of these things. And they have great examples of even finding life insurance policies that were lapsing because missed payments. It had started in its history of finding, can you find mental decline, like undiagnosed mental decline, like dementia, in financial data before a clinical prescription or a diagnosis, right?
Yeah.
And it's true, right? And we're like, that plays into the value the bank should be providing, right? Like, what is our number one thing as a bank that we provide is trust. And it's been hugely successful. In one of my favorite stories, anecdotal, yes, we have quantitative on like the impact, but one of my favorites is in older woman coming in and hugging the bank president because of the value she got from this, because she said her bank was taking care of her.
Yeah. And that's like the kind of stuff that like bankers like to tell stories about, right? Like this is the whole like the value of a community bank is this thing. And people like to be able to tell those kind of stories. But at the same time, you really have to ask, like, when was the last time a new product that you launched caused that thing to happen? And I think for most banks, and particularly for community and regional banks, if they're being honest with themselves, that is very, very rare. And I will add to that example by saying that, like, and I'm a huge fan of Careful. There's a few other companies in the space that are kind of building in this direction. It seems inevitable that it's going to sort of collide with banks because they are the ones who want to productize trust and have the built-in distribution, the 90-year-olds instead of the 19-year-olds, to your point. There's a ton more to do, even in this space, right? Like I think about questions like, why is it that I, as a consumer, and let's just imagine me older than I am and wanting to help enable my kids to sort of have more of a shared view of our finances as a household, or to help me manage my finances or what have you. Like, have you ever wondered even simple questions like, why is consumer permission data sharing single player by default rather than multiplayer by default? Like, why can't I permission my financial data to trusted other parties like my kids or my parents or others? Like, this is stupid. Like, there's so much more to do here. But I think it's infrastructure that's needed in service of thoughtfully designed products that have distribution that's possible through banks. And to me, like, why don't we have that? It's because not enough people have built products to require that infrastructure yet, because they haven't found ways to distribute that type of product, because banks are the ones who have all of the old customers who would want to use that. So like, it's one of those kind of cold start problems in a sense, because you need more BaaS, bank product partnerships as a service. You need more of that to get the flywheel spinning so that more of this infrastructure, more of these products get built.
Well, because they solve the distribution parts, right? So like,
correct.
With you and I started doing the hot takes during COVID, right? And the whole purpose wasn't just hot sauce. It was ideas we have not fully thought through. So this is a hot take I have not fully thought through. So let's use an Alex Johnson. Let's workshop it.
This is a great place to end the podcast, Jason. Go.
One of the things I've been thinking about a lot is banks tend to get so focused on NIM. And by NIM, they really zero in on the loan. Specifically for community banks, the small business loan, or bigger banks, the commercial loan. They don't think about deposits are actually the hard part. All those other services in the non-interest income, right? Like they love their overdraft fees and like the junk fees because they're like cocaine, just easy to get, and you don't have to actually work for it.
Yeah,
right.
Yeah.
But
once
like
you take it,
NII,
hard to walk away.
Right? Like the real NII, like doing something like Careful, right? Like that you actually work for, but then it's like you've earned it and it sticks, right? So the bank ends up focused on the loan. Right. So they're very NIM focused and they don't do these other hard things because they just want the NIM. The fintechs, on the other hand, and this is my slightly more controversial take, driven by venture, they're just the growth at all costs in the metrics to raise the next round are not as focused on the value. And so on one hand, one is only focused on value. Not the right value, but solely focused on value and missing the long game because they want the NIM. The other is focused on the next round, which is a metric-given game. And in between, and I think this is the part that's changing, and there's something to be said about, and I've got a view on this, but we're not going to spoil it now. Here's my teaser. How AI plays into this. And it is not agentic in the, I'm going to go have an agent go do everything for me. But how do I actually have an agent make sure my interest is being taken care of as the business and as the consumer? And that scales all the way up to commercial.
Yeah. No, I mean, I very much agree. That is actually a really good place to leave it, because the next segment of this podcast is going to be a little teaser for an event, Mr. Henrichs, that you are joining, which I'm very excited about. We're getting you back to Montana for the Fintech Frontier Summit, where the things we've been talking about will be the subject of even more conversations. Very small room in a beautiful place, very thoughtful conversations, and maybe a solution or two that comes out of it. So I think that's a great way to set up that event that's coming. And as always, I feel smarter and more optimistic, quite frankly, after talking to you, Jason. Even if we started
this time in Montana, I'm
place.
not doing financial nihilism.
No. It's going to be spring. There's going to be flowers and snow in the hills. It's really like Sound of Music-esque, I will tell you at that time. So like, it's going to be great. No time for
I got my
pessimism.
hat. I got my boots. We're going to talk about, actually, I'm very excited about the solution side of this.
Yes.
Because I do think we are, let's end on a slightly darker note with spring in the background.
Sure.
I am seeing more, and I think we're going to see a lot of the crashing to earth of things, right? So you've seen, Makula's thing on Bolt, right? So valued at $11 billion, now struggling to pay their bills.
Yeah.
We're seeing several startups have exited. By exited, we're seeing soft landings, right? Which, by the way, kudos to anyone who has endeavored to go do something new. If you can at least soft land, it is better than a crash land. But we're seeing a return to the Darwinistic part of the market right now. Now, unfortunately, we're seeing a bifurcation of some crypto and some AI is just like still going off the rails, but the rest of the world, it's going to be ugly for a little bit. But we're back to some hardcore building. And the hardcore building to me is that's where real problems are solved. And that's why I'm excited about Montana, is like there will be some digging into how do we actually go solve hard problems and not just go, the answer is AI. The answer is stablecoin. Now, they may be parts. They're not the solution.
No, I agree. And as you said, it's a continuation of that sort of Builders Summit theme that we started last year. And that I know you have a bunch of events coming up later in the year. So like, I'm glad this idea is getting carried forward. And I agree. I think it's a good time. That wasn't too much of a pessimistic note. I think that was a good optimistic place to leave it. Mr. Henrichs, as always, thank you, sir. I appreciate you carving out the time.
Thanks for letting me rant.
Okay, well, now I am thrilled to be joined by two startup advisors, members of the Fintech Takes network, I'm proud to say, and two of the organizers of the inaugural Fintech Frontier Summit, which we're going to talk a little bit about, AJ Clark and Tom Johnson. Guys, thanks so much for joining me.
You betcha.
Great to be here. Thanks, Alex.
I am delighted to have you both. So this episode thematically is about bank fintech partnerships and how banks and fintech companies work together. You both spend quite a bit of your time thinking about that topic, talking both to banks and to early stage fintech startups. So I'm curious to get your take on both the current state of how banks and fintech companies are working together, as well as sort of how you see that evolving and how you want to see that evolve. AJ, maybe we'll start with you.
Yeah, I'll start with the banks. I think that the banks are at a sort of generational moment with the regulatory environment, which from my observation seems to be more permissive for new technology and for innovation to come in. And many of the bank leaders that I've talked with, they say that the innovation hasn't occurred, not because they didn't want it, but they did have a challenging regulatory environment. That's open now. The second thing is the bank balance sheets are very healthy. They have an opportunity to invest in themselves. And doing that with innovation and new technology seems to be a very promising return on investment. So the environment's set really well. As for is set well for the banks. And I see a lot of appetite for the innovation. On the founder side, you have so much happening with technology. The tools that are available today for a startup to really build a great product, not just a minimally viable product, but something that is feature complete and is designed with security first, designed to meet a specific regulatory environment, and is designed in order for chief risk officers to feel comfortable around what it's doing within the parameters that it's designed for. You have the ability to create these products, but you also have the foundational technical elements for that tech stack to make them delight the user. They're not just solving a problem now within a line of business and a specific workflow where they have to stop with maybe 20 common denominator features. They can build out their tool, and these tools are flexible enough that they can solve many additional challenges and customize them for the individual workflows while unifying data across the organization. So that's sort of the backdrop that I see, Alex. You've got a great moment in time with technology, and you have a really great environment for the banks to be adopting some of that around. The trick is, how do you align everyone?
Yeah, it's interesting because I think, to your point, AJ, there's areas where you see fintech innovation sort of come into the market and then sort of plateau and then sort of dip back down. I think I notice this a lot in consumer fintech, where it's like, hey, there's a moment where everyone's really excited about consumer fintech, and then it doesn't go as well from a distribution perspective, and then everyone gets kind of bummed out about consumer fintech and they stop sort of funding it. But the problems didn't change, and the opportunity to add value in that space or create those delightful experiences didn't change. It's just the cyclical nature of the market. And one thing I'm really excited about, to your point about the new tools and technology that's available, is it should empower an even broader set of founders to attack some of those problem areas. And you might not need to raise $120 million to scale up a consumer fintech company, which is the hard part of disrupting that market, to generate a good idea if you can find a good partnership with banks. Tom, what would you add?
What I would add is that, I've been involved a lot in deploying new technology into these banks. And one of the things that's really interesting, based on what AJ was saying about it being the right time, is there is a really good match between what a bank can do, with their distribution, with the customer base they have, with all of those things, and then what fintech can do, right? It is difficult for a bank to spin up an effort, get everybody on the same page, and then do an innovation internally. It's really difficult to do that. Fintech has that nailed, but they don't really have the ability to be able to distribute and to really, truly understand what all the problems are the bank's going through all this, right? So a match between those two at this point in time can really create some great partnerships, right? Some partnerships where the bank is really getting something that's a game changer for them. The fintechs are experiencing less risk because they're partnered with those banks. They know what they want. The banks are already kind of bought in on that, right? So it is a really good time for that to be a very profitable arrangement for both the banks and the fintechs.
Yeah, no, I agree. And I think that, the other thing that a lot of this requires is just a level of maturity in the market that you don't always see, right? I mean, I'm old enough to remember when fintech companies all just talked about banks are lazy, banks can't get out of their own way, we're going to disrupt banks. And it definitely reminded me of teenagers being like, my parents are stupid. And you have to sort of get old enough, and you have to sort of run into your own problems enough that you realize wow, some of those things are actually pretty difficult, and maybe a partnership would make sense here. And I think the same thing is true on the bank side, right? I mean, I think banks used to be much more dismissive of fintech as a category, right? I'm also old enough to remember bank executives telling me that's stupid. We're not worried about that. That's not going to have any disruptive effect on our business. And of course, that's not true either. And so I do think there is a moment now in time where both sides of the market have become much more mature in the way they think about the other side of the market. And I think that creates the conditions necessary for partnership. The other thing I wanted to ask you guys about is, as I mentioned, you're both members of the Fintech Takes network, which was wonderful. You also were both attendees at the very first Fintech Takes Builder Summit that we hosted in Montana in November of last year. And I loved the summit and thought it went great. But one of the things I liked the most about it was we purposefully tried to create sort of an environment where you could have deeper, sort of slower conversations with fewer people, right? It was very curated. It was very sort of bespoke in the way we designed it. And I think it lended itself well to those types of partnership conversations, right? Because sometimes like if it's a vendor conversation, like, hey, we sell this, we're looking to buy this. Okay, like you can do that in 15 minutes. But if you're talking about how could we work together, what products could be co-designed to take to the market, like that's a deeper conversation that sometimes is difficult to have at sort of traditional fintech conferences. I just got back from Fintech Meetup. It was great, but it wasn't one that lended itself to like deep discussions about potential partnerships. I'm curious what your guys' observations were from the Builders Summit, and in particular, like the ability to have those deeper conversations. AJ, maybe I'll go to you first.
Yeah, I tend to avoid conferences just because of the transactional nature and the short amount of time that you get to spend with folks. They are necessary and there's value to them.
Sure.
But, one of the things I feel is the people that are going to solve the hardest problems in any industry when they're bringing technology in aren't going to sit there and read off their resume to everyone they talk to. Within about 5-10 minutes of talking to someone, you know sort of where they sit with their maturity and understanding of solving the problem. And there's so much more to it than just building a product. And there's also so much more to it than a bank just setting aside money to innovate. And when I say banks, I'm really talking about community and regional banks, right? They're the ones that can benefit from these new startups and some of these new technologies that they probably don't have the breadth of staff internally to build all of them. There's plenty of things they can do internally. But what I really liked about the summit was even the premise of it. Just a step back, in order to get more exposure to the bank tech world, I partnered with a group called EJF Capital, and they've been working with banks, doing a lot of different capital market support to them for the last 20 years. And they were doing some things with ventures starting in 2021. So about that time, I felt like they'd be a good group to help introduce me more into that space. As a former founder, I knew a lot about the technology side, but I didn't understand as much about the banks. And I really wanted to get deep into that foundation. They sponsored this. They were a sponsor of the summit, and it had to be a founder that went. And none of them were founders, so they begged me to go. And I said, "It sounds great. Yeah, I'll check it out." Joy, Montana, a family from the area going back 2 generations. So what I really enjoyed about it, though, was the ability to take time in the dialogue. Nothing was rushed, right? There was some great meetings. There was some prompts that were given to the human agents that were there, and we had to talk about certain topics, which was good for ice breaking. And I also liked that there was a lot of engineers there. Founders and engineers. It was people that were really trying to solve the technical side of the problem. And there was also some prior founders that understood the industry quite well. So the 3 things I liked about the most was just the setting. It was a challenging setting to get to, and it wasn't Miami Beach in January. So that down selected. Then once you were there was just enough bringing folks together with some receptions and setting up topics at tables, but I think it was really well curated, and I think that's important. There might have been, I'm not sure how many folks were there. I guess 75, maybe 50 to 75. So that was really beneficial for setting the conditions for successful conversations, deeper conversations. And then the last thing that I liked about it was the breaks, and there was like activities and breaks where you could sit and have an hour-long dialogue about something with someone you met, rather than having to be rushed back into the next bell being rung for some speaker. So those are the 3 things I felt like were really unique about it. And I think that to solve things within how banks innovate and how these startup founders bring the technology to the bank and meet them where they're at, you need more of those dialogues. You can't just have your pitch decks and you can't have your 15-minute speed dates. There's got to be a group that understands both sides of the equation well and is front running a path, both for the startups and how they can quickly guide their business model to fit the banks, and then from the banks to figure out how do we deal with 100 different companies coming at us with AI solutions that will fix all of our problems. right? So there needs to be a group that really cares about this problem beyond just it's their job and beyond it's just a startup that they want to make successful. You need to get these folks together, and you need to start laying that groundwork and path to block up field for the rest of the community, and start thinking about things like models in AI, model standards, things like, how do you streamline the acquisition process? How do you avoid the false starts with banks or with the new startups in banks? There's a lot of hard problems well beyond that, but I think there's some really passionate people out there, and they're well informed, and events like that Builder Summit can bring them together, and you can get a lot of progress.
Yeah, no, I absolutely agree with that. Tom, you actually met AJ and had, I know, a very deep conversation with him at the summit. What was your experience?
The thing that was really cool to me was when you go to conferences, you rarely ever build relationships with anyone, right? And so, not only did I meet AJ, build a relationship with AJ, but I built a relationship with a lot of people, right? And it was true, like you would hear somebody speak, you would discuss what they said, you would think about that, you got some fairly challenging questions to work through. And when you actually sat down and took the time to listen to people, to understand where they were coming from, to understand, because everybody has the 2-minute answer, hey, what do you do? Blah, 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 and this got beneath that, right? And one of the ways that you did this, that I thought was interesting was, if you go out and do axe throwing with people, you'll learn a lot about them, right? And just like things where you take them outside of what they've ever done before, what they're comfortable with, right? And everybody was supportive, they were interested, they were passionate, but I have probably 4 or 5 really pretty close relationships with people that I didn't have before, right? And usually you only form those with the people you work directly with, right? You don't ever do that with a conference, but that conference, we started to do that. We started to build those relationships. And I think, as AJ was saying, solving some of these problems requires people to build that relationship and bring together different perspective, different resources, different, things in order to really solve that problem, right? Otherwise, it's just somebody mouthing off at somebody else and everybody has a different opinion. But one of the last thing I'll mention is at that conference, by the end of it, it was interesting how even people that, I knew before that I sort of thought maybe I disagreed with, I agreed with him way more. I understood where they were coming from, right? Mm-hmm. And that was a big deal.
Yeah, no, I think that's absolutely right. And just to put a capper on this conversation, I did not ask you both to compliment my conference just because I wanted to feel good, although that did make me feel good. So thank you for that. I wanted to talk about what we all liked about the event because it has become a bit of a template for additional events that are coming down the road. And the first one of these that I'm very, very excited to be attending, to be participating in, and to be helping to shape a little bit, and that you guys are playing an active role in bringing together and shaping, is the Fintech Frontier Summit that I mentioned before. So to wrap up, AJ, give us the pitch on the Fintech Frontier Summit, when it's going to be, where it's going to be, who's going to be there, and what the purpose of it is.
Yeah. So the name kind of aligns with what I mentioned about building a roadmap that's further down than where the industry is now. And so where is that frontier for the industry? And how can you bring some of the most well-informed and talented, experienced folks into rooms to talk about solving those problems and deepen their relationships? Because I think they really want to be supportive, whether it's banks or startups. So the event is a little smaller format than the summit in Bozeman. This one is going to have somewhere between 20 and 30 different participants. It will be held at Alpine Falls Ranch, which is about 45 minutes northwest of Missoula, up I-90. So folks can fly into Missoula Airport and either get cars or the ranch can bring them out. They're also welcome to come a little earlier. We've worked with the ranch so that they can host folks. It would be as early as May 29th through June 4th. The actual programming is scheduled for May 31st in the evening is the welcome reception and dinner. And then breakfast on June 3rd is the final send off. But folks are welcome to come on Friday early, and they're also welcome to stay till Thursday. And this is definitely building, Alex, off of what you started in Bozeman with the Builder Summit, but it's designed to get the worker bees inside the bank, the folks in the trenches that are passionate and have been trying for years to achieve more efficiency and automation. And then it's supposed to bring some founders that do understand banks and have built products for banks before. It's designed to bring some founders that are extremely innovative and on the cusp of the latest releases of technology, which happen every 30, 90 days now. And then some folks in the middle. The objective is to get a group that is going to work together to solve some of these problems that are at the frontier of banks and technology. The main programming will be Monday, Tuesday. The goal is to build off, like I said, your event and try and have some activities and some breakout sessions just to create space for real conversations. Everyone will be staying on the ranch or very close to it, a 5-minute drive away. And what I'd like to see from it is not only the bank participants getting to know each other better and finding ways to collaborate, but the same thing for those fintech startups. And then everything in between, right? So that's the summary of the event. And applications are still being accepted.
Yeah,
but they'll probably close shortly in the next week or so that we can give folks time to get there.
excellent. Well, as you say, applications are still open. So if anyone is listening to this where it sounds like a thing for them, or they know someone in the industry who'd be like, ooh, they'd be perfect for that, please do apply. I will drop the link to the event in the show notes for this episode. And I can tell you, AJ, that I was at Fintech Meetup this week, and I bumped into multiple people who had either applied or who had applied and had been accepted, and like just the level of excitement on their face about like, I'm going to get out of Vegas. I'm going to go to like a really beautiful place. I'm going to have some like dedicated time to carve out of my calendar to think and to talk with folks deeply. People could not have been more excited about it. And I think it's going to be an awesome event. I'm very excited to see sort of this idea continue to progress forward, because I agree with both of you. This is a format, and this topically is an area where I think it's deserving of some really deep, thoughtful conversations and some new relationships that are going to be formed, which is very, very exciting. Guys, thank you so much for joining me and for giving the overview. And I look forward to seeing you in person very soon.
All right. Thanks.
Thanks, Alex. Take care.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.